Hello. Hello from Vancouver, and welcome to the Investing News Network's first online panel discussion, investigating the project generator model. My name is Chris Smith, and I'm one of the partners of the Investing News Network, and I have the pleasure from broadcasting today from our headquarters in Vancouver, British Columbia, Canada. It's our mission at INN to educate investors and connect them with opportunity. And today I believe we have a real chance to do that. First, I want to thank our audience of investors for joining us to learn and hopefully profit from the prospect generator model that we discussed today. We are joined by 3 company CEOs who are creating shareholder value using this model. We have a great lineup and a very full agenda, so I'm going to get right to it and introduce our esteemed panelists. First on deck, I got David Cole, President and CEO of Eurasian Minerals. Is trading on the Toronto Venture Exchange, EMX, and the New York Stock Exchange, EMXX. Got Miles Thompson, President and CEO of Lara Exploration, TSXV, LRA. And Scott McLean, President and CEO of Transition Metals, TSXV XTM. And we are also lucky to have the help and support of one of the industry's legends who has championed the prospect generator model. This man has a long history of helping and supporting and educating investors, and it is my true pleasure to introduce Rick Rule, President and CEO of Sprott U.S. Holdings. Rick, over to you.
Thanks, Chris, and thanks to the people at INN for putting on this investor education presentation. I'm delighted to preside over this panel. I have been interested in and a beneficiary of the prospect generation business model for 35 years. I should disclose that I'm a shareholder, in fact, a substantial shareholder in all 3 of the companies. That disclosure is meant to be the sincerest form of flattery, as I'm not doing it from a charitable point of view. I'm doing it because these people all stand a wonderful chance to make me and my clients some money in the future. Before I get into the presentation, I'd like to give you the type of overview, you the audience, the type of overview that will put the presentation in context. When I was in university, I learned that between 1 in 1,000 and 1 in 5,000 mineralized anomalies became a mine, which means that the normal value proposition offered up to you by Bay Street or House Street is a 1 in 5,000 chance of a 10-to-1 return. In other words, a substantially worse business proposition than the BC lottery. The statistics around prospect generation are very different, though. I have participated in between 50 and 60 publicly traded prospect generators in the last 3 decades in the business. And as a consequence of that, I have participated in now 23 economic discoveries. By the way, Miles, congratulations on your role in the Timok discovery, which is the latest success that I can ascribe to the prospect generator business model. In the course of participating in 23 economic discoveries, I will, with the eventual takeover of Reservoir, should that occur, have participated in 16 takeovers. This is truly an astonishing track record. If you think about 16 successes in, let's say, 55 starts in an industry where 1 in 2 or 1 in 3 or 1 in 4 or 1 in 5,000 becomes a success, the statistical success or the statistical probabilities afforded by prospect generation are probably 3 standard deviations better than the prospects offered up by House Street and Bay Street to investors generally. So I'd like to begin very briefly by allowing, and I mean briefly, each of our panelists to introduce themselves and talk a little tiny bit about their company. Davey, let's begin with you.
Sure, my pleasure to be here, Rick. Thanks very much. And probably the best way to start with that as in forms of an introduction is just talk about my passion for creation of value through the prospect generation process. And I witnessed this growing up working for Newmont Mining Corporation as a corporate geologist. And I watched how Pierre Lassonde built his royalty portfolio on the Carlin Trend. I watched how other prospect generators were able to accumulate project portfolios and joint venture and sell those out where they maintained either royalties or carried equity positions in those projects and reduce that risk that you were just articulating. And I noted that and I said, holy smokes, that's a really interesting way to approach this business. And after working with Newmont for 18 years, I left and got some great backing from folks like yourself. Thank you very much. And we started Eurasia Minerals with those specific business ideas in mind, built around the prospect generation business model.
Miles?
Yeah, I wish I could say I come at it that intelligently. I've funded and worked in exploration privately for over 20 years, and I learned the hard way how painful it is to fund every exploration try yourself. And so I came into the prospect generator business when I decided to give up gambling and take it up as a real business to try and make money. It's really just about using technology and using joint ventures to reduce your odds and increase the chances of success.
And Scott?
Well, Transition Metals is a multi-commodity project generator as well, and my background is really coming out of the old Falconbridge group and the Falconbridge Discovery team there, and the group that I've been able to assemble around me is that Discovery team where we've had great success and been recognized by our peers with a number of awards. The project generator business model is one that really works well for us. It does mitigate our risk in terms of exploration, and you alluded, Rick, to the odds of discovery of turning an investment into a mine. And it gives us multiple opportunities to be involved in discovery. Across the country, we have over 32 projects that we're involved in, and any one of those could result in an economic discovery that will award our shareholders handsomely.
Gentlemen, I'd like you to take your CEO caps off and pretend that you're investors for the next little while. Pretend that you're speculators. By the way, I know each of you individually, and I know each of you can do this because each of you are. I'd like you to differentiate from an investor's point of view between the prospect generator joint venture model and the sole risk explorationist model, and what are the benefits to investors? Again, beginning with you, Davey.
Sure. Yeah, it's a fascinating question, and I have invested in drill and build, so I know exactly how that feels. One of the frustrating aspects of what I affectionately call the drill and build model is that even if you have success, that requires significant additional capital, which requires share issuance, and that's commonly done at a price that's not entirely favorable to the existing shareholders. So it depends upon the markets, of course. And so you're being diluted even in the success case. And then more often it's it's either problematic results or questionable results or negative results, and then the company's still in the same situation. You have to raise more capital. So if you have favorable results, you have to raise more capital. If you have bad results, you have to raise more capital. Either way, the investor is being diluted. That can become quite frustrating. So that necessitates very astute timing, and sometimes my crystal ball is broken, and the timing factor is pretty difficult. Probably is the best way to describe my personal experience in investing in the drill and build model.
Miles, over to you.
I think a lot of, as an investor, you always hope that you're going to buy a share that's going to go up 10 times on Friday or Friday of the following week, whereas the exploration mining business plays out over, years and years, often decades. And the real, from an investor capital market standpoint, I think the real competitive advantage is that you're allowed to go through a whole bunch of different projects and a whole bunch of different market cycles without destroying the capital structure of your company. And as an investor, what you're interested in is the value of the company, the value of the share, not necessarily what goes on within the company. So when you buy a share in a company, you want that share to go up. And the prospect generator model allows you to preserve the share structure and improve the chances of that.
And finally, Scott, Same question. You're a speculator now, not a CEO.
Well, look, the way I'll answer this question, Rick, is, I would look at a prospect generator and compare that to a more traditional junior, or as David mentioned, a drill and build type scenario. That traditional junior generally only has one or two opportunities they're working on. The only way they fund that is by issuing equity or selling ownership in the company, which, as David alluded to, creates a high rate of shareholder dilution. The end game is still discovery, and under that model, that traditional junior, typically, if they're successful, they will have a single discovery. That 1 in 5,000 will be a single discovery, but they'll probably own a significant ownership in it, perhaps 80 or 100%. The problem is you and I as shareholders have been diluted severely, so we own a very small piece of a very large pie, perhaps. Whereas a prospect generator takes a different angle. It has multiple projects, many irons in the fire, has great opportunity to provide a discovery to its shareholder. And rather than selling ownership in the company, it really focuses, it still dilutes, but it focuses on selling interest on its specific project assets. By doing that, it keeps its shareholder equity dilution rate very low. And the end game is still discovery. But rather than being involved in a single discovery of which the company owns a large portion of, the prospect generator will most likely be involved in multiple discoveries, but may only have a minority or even royalty interest. But you and I, as shareholders, will have a much bigger piece of a number of smaller pies. By doing so, we mitigate our risk, we leverage our investment, and we increase our probability of discovery.
I've earned the enmity of Bay Street and Howe Street for years by saying that most exploration assets on most company balance sheets should probably be regarded as liabilities rather than assets because of the low probability of success, but the obligation to spend. And I have felt for many years that exploration, properly characterized as an economic activity, is more akin to research and development. In other words, it's an intellectual capital business rather than a physical capital business. And I want to talk to you about your companies in that context. I want to have you describe your regional focus. You obviously can't all be present in every part of the world. Tell me the parts of the world that you specialize in. Tell me why you specialize in them, and tell me about the intellectual capital within your company that allows you to be regarded as experts and attract third-party capital. And again, Davey, I'm going to start with you. Tell me where in the world you work, why, and who in particular generates the intellectual value for you in those places.
Yeah, my pleasure, Rick. And we've talked about this subject many times, and Eurasia Minerals has a global approach to this business, and I'm oftentimes asked as to how we manage that, and the answer has always been from the very beginning, it's a people-first approach. And the various regions of the world where we have worked, it was because we had specific intellectual capital, both from a geological standpoint, as well as from a business acumen and experiential standpoint. And so we can point to different business units that Eurasian has had or does have around the world, and it would point right back to an individual in each case. And either my experience or Dr. Mesut Soylu's experience in Turkey, or our team in Tucson, which are PhDs out of the University of Arizona, and their understanding of what we call extensional geology. Not to get too technical with the folks on the phone here, but an innate understanding of the geology of the Western United States and how it relates to the copper and gold deposits in the Western United States. And it's humbling for me to get to work with these quality folks, typically with master's degrees, PhDs. We have a whole host of folks with PhDs out of the University of Arizona that help us manage and build this portfolio around the world, which we manage to the betterment of our shareholders, utilizing that intellectual capital. And I could zero in on any particular area. We've got expertise in the Tethyan metallogenic belt that comes from Dr. Mesut Soylu, Dr. Duncan Large, that are consultants to the company. PhDs such as Dr. Eric Jensen with expertise in what we call alkalic mineral systems, which are related typically to gold systems, as well as porphyry copper systems and expertise from Dr. David Johnson. So I could go on on this topic, but to sort of synthesize that, geology and the use of geology to leverage into mineral property positions is our alpha. That's how we intend to beat the market, is utilizing that specific expertise. And the whole business has been built around these astute folks that are wonderful to work with, I might add.
Davey, I'd like to drill down just a little bit. I'm going to depart from the script. In terms of technical specialties, many people focus on one style of deposit. I know you have a lot of U.S. assets. Would you describe your people as porphyry or epithermal specialists? In other words, do you have a technological specialty that you hold out to the industry?
Yeah, we have several, actually. And certainly, I've discussed many times with folks who have heard me talk before about one of my favorite topics, and that's the intellectual value that we have in the company around our porphyry expertise, porphyry copper expertise. And actually, the porphyry coppers and the epithermal gold systems occur in arc terrains, arc geological terrains. And this is a specific geological terrain that exists around the world where you have convergent tectonic plate boundaries. And we've got a really good set of experience around that geological terrain, and thus our bread and butter from the prospect generation perspective is copper and gold, most specifically. We do have other specific expertise in other deposit types as well, but our bread and butter is copper gold in convergent plate tectonic environments, what we call arc terrains. And without getting too technical, that's an area where we have a lot of passion and a lot of expertise, and that occurs in multiple regions around the world.
Thank you. Miles, we're going to move on to you, and I want you to talk to me first about the regional specialty of LARA and why, and what intellectual capital or experience allows LARA to stand out and compete.
Yeah, I mean, we've certainly been, for a variety of reasons, more regionally specific. I suppose my view as a businessman is that if you want to beat the competition, you have to have an edge. So in terms of your experience or your technical skills, you need to be better than the competition. We focused on South America. I've been down there living and working for 30 years now. Mike Bonnell, our VP Exploration, has been there for 40, and the rest of our team are similarly experienced people. So we're effectively a very deep pool of knowledge on how to do business in those countries, the geology of those countries, and a network of industry contacts that brings us the deals and brings us the joint ventures. So it's very much a business focus. We have had more success in some areas than others. We've made money in the fertilizer space. We've made a nickel discovery that we were able to sell, and we've had some perhaps more interesting success discovery-wise in copper and gold in the IOCG belt of the Carajás of Brazil. But we're more about, I think, being embedded in a district and making sure that we know what's going on there, and we're able to pick up opportunities as they become available over time, and have the network of business and technical contacts within those countries to get something done with what we find.
And Miles, would you describe your group as having technical specialties in deposit types as a durable competitive advantage? And if so, what? No, I think we're more generalists. I think we're old school explorationists. I think you have a generation or so of explorationists that is of the view that they can find a discovery by looking at some satellite images from the comfort of their computer at home. We're kind of old school. We're out in the field and hammering off bits of rocks and throwing them in a bag. And it's not necessarily what we go to see that's the most interesting thing. Sometimes it's what we see on the way home. That's a really good answer. And I'm going to depart from the script again, Miles. I'm sorry, but you have another interesting story to tell about a past life. That is that you, oddly with some assistance from Davey, started Reservoir Minerals and recently participated in an absolutely spectacular discovery in Serbia. If you could give us a very short form description of how that came to be, how you got interested in the district, how you brought in the joint venture partner, how the discovery occurred, and the transaction that has generated so much shareholder value in one of the worst bear markets in resource speculators' memories.
I think you go into a district based on the geology. Certain parts of the world are much more endowed than others. Lara is based on 2 portfolios in the Carajás in Brazil, each of which took 10 years to build, and we went into Serbia in the same way. I originally went in on a privatization process when I was with Gold Fields. Ourselves and at the time Phelps Dodge both lost out, but came away with an impression that the Timok was one of those spectacularly endowed belts, and for historical reasons no work had been done in the exploration side probably for 30 or 40 years. I had the good fortune to catch Dave at a point where he wanted to get out of Serbia, so as a starter we took his portfolio, and then we subsequently, in the crash of 2008, were able to buy the old Phelps Dodge properties, and we gradually accumulated other things. And I think people forget the timelines here. It took 10 years for us to put that portfolio together, and a lot of these people look at these joint ventures, they need to be really, really expensive deals and splashy headline numbers. Our joint venture with Phelps Dodge, or with Freeport by then, was for them to invest $3 million to earn 51%. The key, I think, is to dedicate your time and your resources to looking for the kind of discovery that would make a difference. I think too much money is spent looking for things that, even if you're successful, don't move the dial. And so it was really a real estate play and a good relationship with Freeport that led us to that, and it's been a hell of a ride.
It truly has been a hell of a ride. Scott, let's move on to you. I'd like you to describe, first of all, your firm's regional specialty and the intellectual capital that you bring to bear. Well, let's start there.
Yeah, certainly. Thanks a lot. Well, my 2 other colleagues here, one's a global prospect generator, and another is a South American prospect generator, and we happen to be a North American prospect generator. Our team has worked pretty well all of our careers in North America. We like it. We think it's a mineral endowed area. It's economically stable, and it's also politically stable, and has geology that can reward us with success. We operate in, I guess, 5 or 6 jurisdictions across Canada, but have a fairly strong nexus of projects in Ontario. Regarding our expertise, we would classify ourselves as being part of that Falconbridge group that had great success in the early parts of this century. We have good, strong technical success in VMS deposits, in gold deposits, and particularly our key and low gold deposits. But also, but where we've really been recognized is with our success in magmatic sulfides, or the nickel, copper, platinum group element deposits. To that measure, we've had significant success in Sudbury. We've discovered ore bodies there that have resulted in awards being offered to us. We have also recently been able to pick up, unheard of in a camp like Sudbury, a couple of very key world-class exploration plays nestled between mines with resources on them that we're actively drilling as we speak today. Also, we've focused on our platinum opportunities with our partner Impala Platinum out of South Africa in the Mid-Continental Rift in and around Thunder Bay. And that's an area where we've seen some new discoveries over the last part of the first part of this century, notably Lundin's Eagle deposit, Rio Tinto's Tamarack, and so on. And we've come up with a brand new discovery near Thunder Bay called Sunday Lake. Been recognized with the Ontario Discoverers of the Year award in 2014 for that. And that deposit now has a size of about 800 by 400 meters of mineralization, with one of the more important platinum intersections coming out, having been reported in many centuries, and that's about 43 meters of 3.5 grams, mostly platinum. with about 10 meters of 6. So in terms of answering your question, we are focused in North America. We like it here. We're very comfortable here. We've explored most of our careers here. And in terms of specialty, we're very comfortable in the volcanogenic massive sulfides, low gold, Archean low gold systems, but have had significant success of late in the magmatic sulfides.
Great, thank you for that. Thanks to all three of you. The next round of questioning from myself will have to do with the type of partners that each of you prefer. Certainly not all money is created equally, so I want to talk to you about how you have built your companies and how you continue to build your companies and which type of partners you prefer, and also how do you like to structure the deals. How do you like to be compensated? Do you want royalties? Do you want equity in the company that's earning in? Do you want a retained interest in the property? So I want to get into the nitty-gritty of what you're doing. What are you requiring a partner to do? Do you want to operate? Do you want them to operate? Tell me about the transactions that you like to generate and how you like to build the companies on other people's money. And once again, I'm going to pick on Dave first.
Sure. There's a lot wrapped into that question, Rick.
Yes, there is.
Yeah. So first of all, what type of customer do we typically seek? And we have a philosophy at Eurasia Minerals, which we started with in the beginning, that was we are aimed towards project success. So we want the right partner for the right property. And we want to marry the right asset with the right folks. And your discussion about not all money is created equal leads very nicely into the important point that there's other people's money, which helps advance the portfolio, but there's also other people's expertise. And ideally, you want both being employed upon your asset, and sometimes it's the expertise is worth more money because it takes substantial expertise to discover and build an ore deposit and build a mine. So looking for that right partner is paramount. And now how we've specifically tried to address that over the years, we've had a whole host of different partners that we've executed different types of deals with in the 13-year history of Eurasia Minerals. So we have a lot of experience actually around this topic. And we've done deals with everything from small private Turkish mining companies that we thought that would be astute at advancing lead zinc silver projects that we had in Turkey, all the way up to working with some of the largest mining companies in the world, including multiple deals with Rio Tinto, pursuing porphyry projects in Arizona, which would have a very long timeline and a substantial capital expenditure requirement in a success case, and everything, and a whole host of different examples in between. So if you'd like to ask any specific questions around various deals we've done, that'd be good. One example I can give you is early in the history of Eurasian Minerals in Turkey, which was one of our first business units that we focused on. We formed a regional strategic alliance with Barrick, and Barrick came in, they bought stock in Eurasian Minerals. We had a very good working relationship with them. We used their money to build a portfolio, doing early stage prospecting throughout the Tethyan metallogenic belt of Turkey. And we found a number of interesting occurrences and acquired a portfolio. And ultimately, nothing was large enough for Barrick. That's a common life cycle for these things. And they leave. We have 100% project ownership now with the benefit of all the data that was produced at Barrick's expense and with their expertise, I might add. Now we're able to take that and say, okay, what type of partner would be good for these assets? And Sisorta was one that came out of that. We sold Sisorta on to a junior Australian company that was all fired up to pursue that particular type of gold deposit. And they spent a substantial amount of money on that asset. They made payments to us. So we're cash flow positive on this asset despite the fact that it hasn't produced an ore deposit yet. And they ended up drilling off a small resource. Wasn't good enough for them. The markets were tough. They walked away. We ended up owning the project again, 100%. A local Turkish company comes along and says, oh, you know what, we're a local Turkish company and we can produce this deposit at a lower price, and they came in and do a deal with us and make payments. And it's a great example of how you seek a partner that's right for the asset over time, and that can vary with time, with geologic environment, with the type of project that you're pursuing, what the future capital expenditures would be. Certainly from the big picture perspective, we'd like to do deals with major companies that are very well funded and have a lot of expertise. But there are niche opportunities where you want to work with different companies as well. And that's some of our experience share throughout the history of doing this business. Now, speaking to how we structure the deals, which was also part of your initial question, Rick, and that's something that has evolved for us over time. Certainly, all prospect generators seek to have some carried interest in the asset, whether it be project equity or royalty equity. And different folks have different opinions as to how that works best for their shareholders. Over time, our opinion on this is that we've moved more towards royalties. We're happy to avail 100% project equity to our partners. We found that that has increased deal flow. That gives the partner more of what they're looking for. And the royalty instrument at the end of the day has the least risk with the most bang on the risk-benefit analysis for the shareholders, in our opinion. So most of our deals that we do now are more royalty-focused. We're able to say up front, all we're getting out of this deal is a royalty, so it better be a good one. And by the way, we'd like some advanced minimum royalty payments or lease payments or share payments associated with this deal that are tied typically to stage gating or advancement of the project over time. And we've found that that's been the best for us. It's helped us maintain deal flow in the roughest of times, and it's helped us attract major companies because the major companies like to have more project equity. We're absolutely delighted to be able to organically build a royalty portfolio through that process. And I think I touched upon most of the points, but you may want to ask me a more detailed question on some of that.
I'll come back and ask you some more questions, Dave. Thanks for that. Miles, can you answer the same sort of question if you've forgotten? Preferred partners and deal types and why?
Yeah, no, we have a very clear strategy on that. We're looking for billion-dollar discoveries. So obviously when we look for projects, we're looking for projects that would be attractive to a mining company. We start by talking to the larger ones, but certainly our focus is to secure a deal with a mining company that would fund the risk through to a point where we have something that you could consider an asset, whether it's a minority interest in a feasibility study, a royalty, or some other structure. Doesn't really matter. It's deal-by-deal basis. But while we are focused on looking for those major discoveries that will deliver the shareholder return that everybody wants, we have to remain sustainable as a business through what are fairly brutal market and commodity cycles. So what we've done is the projects where we see some value that aren't suitable for a major or are returned by a major as being too small or not fitting their portfolio, we will sell to a local company, or we'll swap the shares in a junior, or we'll do some other transaction. And we've actually funded our company and remained active through the last 4 years of the worst bear market of my career on selling shares that we had in other companies, selling projects to other smaller companies, and deals of that nature. So I think for us, it's both looking for that discovery and how to do that without destroying the company, but also considering the markets we work in, sustainability as a business.
Great answer. Scott, same question.
Right. So I guess it's really on a case-by-case basis in terms of how we select or target a partner. The key is to find that partner that's going to be strategic, that the project meets the needs of that potential partner. In some cases, we do have some smaller projects. For example, we have a gold project that's drill ready and permitted in BC. It's probably it's a little too early stage for some of the big companies, but would be an ideal kind of project for a new startup junior that's looking for a project that they can get out and drill some high-grade gold. Alternatively, we have projects that are much better suited for major companies. For example, in Saskatchewan, we have a very large sedimentary hosted copper package that we think we can put resources together on very quickly. It's probably a little too large for us. We've got 25 kilometers of strike length, and it's very similar and analogous to Metallo Invest's Uticon deposit in Russia. That is very much suited for a large company, and we would seek to find one of those copper producers that would be interested in getting involved in a very interesting copper project. So it's really kind of conditional upon the project who we kind of target. Not having said that, having a major company come alongside of us, like Impala, who's been our partner since 2008, does give us a bit of an endorsement, and they bring a wealth of knowledge to us and really help support the projects. In terms of the types of deals, Rick, that we like to do, again, we kind of structure those relative to the type of project it is. We've been very successful with what we call strategic alliances. We've had 2 strategic alliances with Impala Platinum, as well as one with Nunavut Resources Corporation, which is owned by the Kitikmeot Inuit of Nunavut. In both of these cases, we bring our expertise and local expertise to the package, to the partnership, and we're funded by the other partner to generate projects. So even before we have an asset, for example, in the Impala deal, we were able to be funded to go out and find that asset, bring it into a joint venture structure, and in this case at Sunday Lake, we've advanced that strategic alliance to a joint venture where they're funding the joint venture through to completion of a feasibility study, and we have a 25% carried interest through to that point in time. So that's been a very helpful structure for us. We also have done a number of standard option and joint venture arrangements where we are either the operator or not the operator, but in those cases we have specific assets where we have companies like Go West and Aldershot coming in, funding the project, making commitments and required expenditures on the projects in order to earn an interest, and then often those options fall into participating joint ventures, or to in our favor to a carried joint venture like we have with Impala. We have sold assets outright, and in each case we have retained royalties on those to be able to secure some of the upside. And one of the things that's been really successful for us, we're always looking for partners first, but when we haven't been able to secure a partner quickly, we have spun out the assets into subsidiaries. A good example of that is Sudbury Platinum Corporation. We had a couple of key assets in the Sudbury district. We didn't secure a partner, so we ended up placing those out into a new vehicle called Sudbury Platinum Corporation. We took back 100% of the equity, and then ran that sub more like a traditional junior and diluted and suffered the shareholders' dilution in the sub rather than in the parent company. To date, our shareholders have received that very well. We've raised over $7.5 million in that company. We now have a 36% ownership. I've just completed $3.5 million financing, giving that sub a value of about $12.7 million. And our 36% ownership in that, interestingly, is equal to our market cap in Transition Metals. So there's an undervalued opportunity for the listeners to get involved with Transition. We're just starting a new one called Canadian Gold Miner, and we've taken a collection of our gold assets in the Abitibi. We've placed them into Canadian Gold Miner and taken back equity, and now we're doing additional stock deals to consolidate a specific part of the Abitibi in the southwestern part. So those are the structures that we use: strategic alliances, joint venture, option joint venture arrangements. We do sell assets from time to time, not often, but creating our own partner through subsidiaries has also been a great benefit for our investors to date.
Thank you, Scott. You know, one of the things that I've always enjoyed about the prospect generator model, well, actually two things that sort of make one, has been that despite the fact that Sprott spends about $3.5 million a year on original research, that is geology, engineering, financial analysis, travel, that type of thing, I've always been struck that when I invest in a prospect generator, that a whole bunch of due diligence is being done for me by the mining companies that are earning into the prospect generators' projects. I remember having an epiphany in the 90s walking through TechCorp and seeing that they had 210 earth scientists working for them, a number that I couldn't possibly have been able to employ myself. And the idea that in the joint venture model, the major mining company or the industry partner conducts due diligence effectively on my behalf, and also brings more than money, brings technical expertise to bear on the projects that they acquire, would appear to me to be one of the key advances of the prospect generator model. What I would like each of you to describe is, in your own experience, and talk about this from an investor's point of view, the level of due diligence that you have been subjected to, first of all by Bay Street, that is by the brokerage firms, and then by industry partners. The difference in depth to which somebody studies when they're earning a fee relative to when they're writing a check. And Dave, I'd like to begin with you again.
Sure. Yeah, and that's chalk to cheese, the comparative between those two different institutional groups. So, the way Bay Street, as you put it, would analyze us, they're largely looking for, if I'm not oversimplifying this, a story that's sellable to the brokers and sellable to the retail crowd, and they're looking for sound bites, interesting addresses, not a lot of great technical due diligence at all. In fact, very few institutions, investing institutions, actually employ earth scientists to start and actually do any technical due diligence whatsoever. So I'll just sort of leave that at that. I would say that they do good due diligence on the people side and understanding who has what sort of expertise and track records, of doing well for shareholders over time. And so they probably look at the people side of the equation more on Bay Street and less on the technical side. From the perspective of the prospective customer, big company, small company alike, the due diligence can be exhaustive, and it actually can become a significant challenge to the prospect generator, in that it requires a lot of time and effort on our part to organize our data sets, particularly after they become larger on more advanced assets, and to communicate with the prospective customers. And this is our marketing effort. This is our sales job that we have to do. It's a necessary evil of the business model for sure, and it's an area that, quite honestly, we've learned you have to focus on diligently in order to maintain deal flow. And that due diligence can be just outright exhaustive. With their own computer modeling of resources or drill results, their own sampling programs on site to evaluate the geochemistry, their own geological due diligence of the various data sets, including in the field transects and small mapping projects and whatnot, to try and piece things together and understand their own mineralogical interpretation of what's going on and on and on. Not to get too technical about it, but it's pretty interesting to see that process, and a lot of effort can go into it. It can take a substantial amount of time. It's one of the reasons that slows deal flow, if you will, and one of the reasons why it needs to be well managed.
Great. Miles, same question.
I think to suggest that the banks and the brokerage houses really do due diligence is probably not strictly true. We've had cases where a consultant for or an analyst at an institution has run a model or has been to site. Occasionally they've hired lawyers to check stuff, but it's not what I would call due diligence. Due diligence, as done by a company where they're going to put their balance sheet and their money at risk, is something far more thorough, covering every aspect of the work you've done, but also doing their own checks. They don't actually believe anything you give them. They'll hire their own lawyers to do what your lawyers have done. They'll hire their own geologists to do what your geologists have done, and their own engineers as well. So I think one thing is the bias, in the sense that from an institution, the analysis is geared to generating banking or brokerage fees, whereas when a mining company does due diligence, they're actually going to put their own balance sheet and their own team and their own finances at risk in your project, and they actually do a real due diligence ahead of putting that money at risk.
Scott?
Yeah, generally just echoing both of my colleagues' comments there. When we deal with major companies and mining companies, the due diligence is quite simply put at a much higher level. We have their own geoscientists. It requires providing large sets of data that they analyze internally, which we may or may not see any results from their analysis. Often 1, 2, sometimes 3 site visits to verify elements of our work. And as Miles said, they're really making an investment of their own money into a discovery. And that's what they're really focused on, is that discovery element of our project. Due diligence is very high at that partner level. And we've seen that with our partners from Impala, for example, where they have their own geoscientist that works directly with us and really scrutinize the data sets significantly. The Bay Street folks, the retail folks, in general, these are very general comments. I mean, a good PowerPoint is very important, I find, and that really kind of gets them interested. They generally have to like management, as David said, and track records and presence and confidence are all part of the sale to them. And they're looking for opportunities for share growth rather than necessarily opportunities for discovery. Overall, we've all echoed the same message. The amount of due diligence we're seeing from partners is at a significantly higher level than we see from the Bay Street folks, and that's what gives investors coming into these prospect generators a lot more confidence. It's that validation by a senior group that knows what they're doing.
I want to reiterate for our listeners this very important point from my point of view. The level of due diligence that's done on the property portfolios of prospect generators by joint venture partners is probably an order of magnitude more thorough than the level of due diligence that's done by the so-called independent research arms of the investment banks. This is probably the most important of the intangible benefits that you get from investing in a prospect generator. The second important point is that when a joint venture partner, particularly a major joint venture partner, joint ventures into a prospect generator's property, the intellectual capital that they bring to bear in terms of the internal technical expertise that they have is spectacular. The epiphany that I talked about earlier, walking through tech, involved one certain joint venture partner, and it was very clear to me that walking through tech, with 210 earth scientists, geologists, and engineers working for tech, if they encountered a technical challenge, a question with regards to a property, it's very likely that somebody within that 210-person team would have encountered that same problem before. While it is very difficult to believe that a very small company, the prospect generator, with 2 or 3 or 5 or 6 earth scientists on staff, that they would necessarily have the range of expertise that the joint venture partner had. And amazingly, the joint venture partner paid to apply the expertise for the benefit of both their shareholders and the shareholders of the prospect generator. This is a very important take-home. I'd like to return now to the script, and I'd like to ask each of you briefly how you as an investor would evaluate other prospect generators. In other words, we're going to put the cap on the other hat now, and each of you would, if each of you could describe briefly how you would evaluate other prospect generators, not from a competitive point of view, but rather from the point of view of your own portfolio speculation. Dave, let's begin with you.
Yeah, happy to answer that question. And it revolves around this concept that where the rubber meets the road is in deal flow. And because of this exhaustive due diligence that's done on behalf of the customer or the incoming partner, ultimately, does the prospect generator that I'm thinking about investing in, and I've invested in prospect generators for sure because I'm a wholehearted believer in this business model, and I like to invest behind folks like Scott and Miles, fabulous people running fabulous companies. And where the rubber meets the road in the prospect generator business model, in my opinion, is the prospect generator getting deal flow? And then the next follow-along question from that is, once they have that deal flow, are the partners spending money on the assets, or are they expending expertise on the asset? And those two combinations are the best litmus test to success, but then you have to go back and equate that back relative to the market cap and enterprise value, of course, doing proper financial due diligence with respect to are the shares overvalued or undervalued. We're in a market situation.
Great. Miles, I know you've done a lot of this for your own portfolio. Could you talk to that?
I suppose, given the unreliability of being able to count on an exploration success within a certain time frame, I look more at simpler metrics. So I like to invest where I know that the technical people have the necessary expertise and competence. Preferably they've already made discoveries. I like to see companies that the people running the company have the same interest as myself as a shareholder, i.e. they put their own money in and they're substantial shareholders. They're not just taking a salary and some options. And then I also look a little bit at the way the company's structured. I mean, you look at just juniors generally. Some of these junior companies have hundreds of millions of shares, and they've rather lost their way. So I kind of look for a fairly, an intangible but a real business focus. I mean, like I love the way David's been building up a portfolio of royalties. I think the skill set and the history of success within Scott's company, and they're really focused on rocks they know well, and although they've been in business for a considerably shorter time than Lara and Eurasian, it's pretty amazing what they've put together in the way of joint ventures and properties within that short period of time. So it's a mixture of those things.
And Scott?
Well, Rick, as you mentioned in your INN article yesterday, it's important to align with those teams that know how to discover and not just acquire. And that sort of was echoed by David there with saying, okay, lots of groups can go out and acquire properties. They can do lots of staking. They can pick up properties for cheap prices from prospectors. But if you don't see that deal flow, a good measure of a prospect generator is not how many projects they have, but how many deals they're doing. That really tells the investor how marketable the projects are that they're acquiring. So that's a good litmus test. It's a good way of measuring. Also, capital structure. We've talked a lot about dilution here, and equity, shareholders' equity dilution, and that's obviously one of the key elements of a prospect generator, that we keep our share structures tight. And you look at my other two colleagues that have been in business longer than I, they still have very tight share structures. Eurasian, for all the work they've done all over the world, is very well situated, as is Miles with Lara. We do see prospect generators start to evolve or show their pop out of their holes when the cycle is low. That's when they don't want to go out and necessarily recapitalize the company at low valuations, particularly at the end of last year and in 2014 when valuations were at all-time lows in these junior companies. And remarkably, some of these companies do become or tout to become project generators, but still have a huge capital structure that doesn't support the project generator model. But I'd like to see how those companies perform as we come back into the bull market, and whether they'll stick to their guns as a project generator or revert back to a more traditional style of junior exploration.
That's a great answer, gentlemen, from all of you. We are towards the end of our presentation. I would like to use the time that we have remaining to do a couple of things. First of all, mention that INN and all three of the companies will be presenting at the Sprott Natural Resources Symposium in Vancouver, July 26th through 29th inclusive, and I would invite anybody that's listening to this podcast to come see it. In addition to that, what I would ask is that each of our presenters talk about how the listeners in this show can contact their companies and where they can find out more in a very brief fashion. Dave?
Yeah, sure. Thanks, Rick. And I noted I was cut off there momentarily. I hope that you got the bulk of what I had to say in the last question. A little technical difficulty. So the best way to get a hold of Eurasian Minerals is eurasianminerals.com. And you can email myself. I love talking to shareholders or prospective shareholders, dave@eurasianminerals.com. And you can also reach our investor relations gentleman, Scott Close, via that website. Our contact information is at the website. Very importantly, there's a PowerPoint presentation, of course, on that website that goes through and discusses the anatomy of the business model as well as the anatomy of our 1.5 million acres that we have worldwide that we manage for the betterment of our shareholders within that PowerPoint presentation. And then to get into the greater details, because of course the PowerPoint presentation is just sort of skimming over and talking about the aspects of the business model and how it's being executed. If you want to tear into the details, which is a lot of fun, you can get the asset handbook from us. You can tell Scott you'd like to have the asset handbook, and that goes into the details of the 70-plus projects that we have worldwide, and it's a really interesting read, and you can see the type of deal structure we've executed on those various assets, their geology. We've gotten back a lot of comments from folks even outside of the technical realm that say that they really appreciate the opportunity to go in and read that. So that's another tool that's available to the investor. And I'm happy to take phone calls anytime. Our information's on the web.
Thank you. And Miles, how do we learn more about Laura?
Pretty much the same thing. LaraExploration.com. We have a website. The BC Securities Commission may be updated recently in a bunch of areas, so pretty much up to date. Our contact information is there as well. We have a relatively tight share structure, as I commented earlier on. We view our shareholders and investors as partners. Very happy to talk to you, respond to questions, answer email. I'll personally be at the Sprott conference in July here in Vancouver. Happy to meet with any shareholders that come. We're a small organization, so we're pretty easy to deal with.
And Scott?
Yeah, pretty much ditto. Our website is transitionmetalscorp.com. My email is smclean@transitionmetalscorp.com. Always happy to chat with folks. For investors looking to get involved, we look at ourselves as being quite undervalued. We think it's a buy at whatever it is today, 15 cents, a $4.5 million market cap. For those listening that are potential partners, we'd love to hear from you. We do have project presentations for each of our projects that we'd be happy to provide you with upon your contacting us.
Gentlemen, on behalf of Sprott, I would like to thank each of you, and I'd particularly like to thank INN for putting on this very responsible investor education product. I've had a delightful time doing it, and I've learned a lot. I think that every single participant in this call has received benefit. So, Chris, back to you. Thank you very much.
Thank you, Rick. You did a great job of extracting a wealth of insight. It was a great conversation. We, too, would like to thank all the global investors that were on this discussion, and like to thank the people behind the scenes for making this possible. Please share your comments, suggestions, ideas for future discussions at info@investingnews.com. And finally, be sure to keep up to date on the resource sector at investingnews.com. We have over 40 specialized investment segments, including gold, silver, graphite, uranium, potash, cobalt, graphite, and copper. And once again, thank you for all participating. That will do it for us. I'm Chris Smith, and for all of us at Investing News Network, thank you for joining us today and wishing you the best in the markets.
Thanks, everybody.
Thank you.
Thank you.
Yeah, thanks a lot for putting this on. Really appreciate it.